The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box Europe. Karen Cho, Juliana Tattlebaum, myself, Steve Sedgwick, and these are your big headlines today. So the president, Mr. Trump, hitting trading partners with higher tariffs from August, including 25% on Japan and South Korea. Don't forget, these are erstwhile allies, and warns against countermoves, whilst the Treasury Secretary Scott Bessent says the US is weighing several new deals.
My mailbox was full last night with a lot of new offers, a lot of new proposals, so it's going to be a busy couple of days.
The European Union is reportedly set to dodge any tariff escalation, with Ireland's trade minister saying he expects an extension of the status quo, allowing time for further talks. Officials from Japan and South Korea hold talks with US Commerce Secretary Howard Lutnick, saying they have agreed to hold further talks before the new tariffs come into effect at the start of next month.
And Trump's tariff letter spark a Wall Street wobble, with the major averages closing around 1% lower, and European equity is set to edge into the red as tariff uncertainty casts a global shadow.
Good morning, good morning,
Good morning.
Good morning. Wall Street wobble. What do they know on Wall Street? Genuinely, I say that. What do they know on Wall Street? They know absolutely nothing. Say it again, because that's part of a song. They do nothing because we know nothing, because the administration doesn't know how this is going to go. I've seen two pieces of research in the last 12 hours. One from Goldman Sachs, upping their estimates on S&P valuation. The second has just hit my inbox and says, we do not generally expect these proposed rates to take effect from August the 1st, although there is a clear risk that higher rates may take effect in a few countries on the list, at least temporarily. That said, we continue to expect the announcement of sectoral tariffs fairly soon. They don't know. You don't know. Does the administration know?
But in the face of uncertainty, what do? You take a little bit of risk off the table. We keep on mentioning how strong markets have been, record after record, and that's what we've seen. To me, the devil in the detail that we had yesterday, we've got a deadline that is not 100% firm. The uncertainty could kick on. We've got letters being served to various different countries, different percentages. So where does that land in terms of the US economy? So the uncertainty, I think, is what investors are reacting to.
You know, I actually love the word wobble. I think the producers chose it well when they were writing the headlines.
Be careful with the word wobble.
Wobbling over here. This is the word wobble, perfect for markets, not necessarily perfect for you, don't worry. But it was perfect because markets stumbled a little bit, they wobbled a little bit, but they didn't sell off massively, which suggests the market doesn't believe President Trump with these tariff threats. The only thing we learned is that a deadline set by the Trump administration is no deadline.
And the other thing we always know is the market will always take it's a glass half full. It's a glass half full. Rather than the glass here. Anyway, look, we'll talk about this for hours and days, as we tend to do. But again, Wall Street wobble, because the president has warned at least 14 countries' imports are set to face steep blanket tariffs from August 1st. Yes, that's a new date that started coming in, isn't it, in the last 24 hours. In letters sent to the leaders of 14 countries, and I did say including key allies, you know, they are historically allies of America, Japan and South Korea, the president warned of higher levies unless they negotiate a trade deal with Washington. Trump also signed an executive order extending the negotiating deadline from July 9th until August 1st. There you go. So July 9th wasn't a hard deadline after all. Japan and South Korea could face a 25% tariff rate, although that will not be combined. It's in block capitals here, so I'll say it again, will not be combined with previously announced sector tariffs such as those on autos and steel and aluminium. Smaller US trading partners such as Serbia, Thailand and Tunisia, wow, plucked those three out, didn't we? Were also hit with fresh levies. Trump warned that any reciprocal measures made by affected countries will likely be met with a response. Well, our US colleagues had a great interview, I hope you all saw it yesterday, with the US Treasury Secretary Scott Bessent, who said countries were rushing to make last-ditch trade offers.
We are going to have several announcements in the next 48 hours. And, Joe, I think what President Trump is concerned about is the quality of the deals, not the quantity. As you could imagine, as he started herding the cats and trying to get everyone across the finish line, when he said that there's a chance that countries could boomerang back to their April 2nd reciprocal tariff levels, we've had a lot of people change their tune in terms of negotiations. So my mailbox was full last night with a lot of new offers, a lot of new proposals. So it's going to be a busy couple of days.
Let's take a look at how markets reacted to the tariff letters and in general to the tariff news flow for the last 24 hours. We saw a bit of a pullback, as we were saying in the opening, a wobble, a Wall Street wobble. We are still higher than where we were on April 2nd, but modestly lower this week. We are looking at the Dow, the S&P, and the Nasdaq off modestly yesterday. In terms of Asian trade, this has been quite interesting how the Asian equities have reacted. We've got green across the board here, including the Japanese and South Korean markets, both up notably this morning. The same for the Hang Seng and the Shanghai Composite. So overall, investors really shrugging off an escalation here on the trade front. Now, looking at European futures, let's take a look at where things stand. Just about an hour away from the European market open, we're looking at green arrows here as well. So all systems go for investors, it seems, this morning.
Well, since President Trump's initial tariff announcement in April, the US has agreed only 3 trade deals with the UK, China and Vietnam. Washington is also reportedly closing in on a pact with India. The EU is not expecting to receive a letter from the US today, according to one EU diplomat speaking to CNBC, with officials looking to agree a framework agreement with the US, which would lock in a 10% tariff rate beyond the deadline of the 1st of August. The deal could involve some concessions for sectors including aircraft parts and spirits. The European Commission told CNBC negotiations are ongoing. EU finance ministers are meeting in Brussels with defence spending and boosting investment on the agenda as US trade talks continue. The ECOFIN meeting comes a day after Pascal Donohoe secured a 3rd term leading the Eurogroup after Spain's Carlos Cuerpo and Lithuania's Rimantas Sadiets abandoned their rival bids. Let's get to Charlotte for more from Brussels. Charlotte, just walk us through the developments here, because we were talking to the Spanish finance minister the other week about his bid to take over Eurogroup, but it seems as though Pascal Donohoe has prevailed.
Thank you, Karen. Well, we're going to ask the man himself, Carlos Cuerpo, the Spanish economy minister, joining me here in Brussels. Thank you so much for speaking to CNBC. So you dropped out of the race to be president of the Eurogroup yesterday. When you were a candidate, you said you wanted to revamp the Eurogroup, that we need to be more efficient in coming up with deliverables, otherwise we might be late to the party. So are you confident now that Pascal Donohoe, in his 3rd mandate, might be able to deliver that?
Well, actually, my first message would be a message of congratulations to Pascal for his 3rd term. And what I told him yesterday was that Spain will be constructively helping him in his 3rd mandate. I will, of course, be contributing to the discussions to this end, basically, that the Eurogroup can be up to the challenge in these very difficult times.
And when we spoke to you last week, you talked about issuing common debt to finance defense in Europe. Do you think this conversation might make any progress soon?
Well, we're already doing it. I mean, we approved the SAFE instrument, which is a joint debt financing for loans for defense investment in the EU, 150 billion, actually, that was approved during the Polish presidency just a few weeks ago.
So let's talk about trade, because that's the whole conversation going on at the moment. The White House announcing some tariffs on a series of countries, including Japan and South Korea. We understand that the Commission is still in negotiations with the White House to try to lock down a potential framework for a trade deal in the coming days, around 10% tariffs from that new August deadline with some exemptions. Are you confident that the EU will reach a deal with Washington?
Well, I want to be optimistic. There's been progress over the past few weeks along those lines in the negotiation around tariffs and on tariff barriers as well with the U.S. Trade Representative, with Jameson Greer, and between also the Commissioner, Maroš Šefčovič. So I think we're getting there. It's not an easy race. It's not an easy negotiation, as we all know. And I think it's a good sign that we're making progress on that front, but still more to do. Of course, it's always hard to pin down the details and to include all relevant dimensions, including also, of course, negotiations on specific sectors such as the automotive and steel and aluminium as well.
We see some countries making some concessions in order to get a deal through, like Canada dropping their digital services tax. There's some calls for Europe to potentially do the same. Do you think would be a good idea?
Well, I think we need to have a beneficial agreement for both parties. As I've been saying all along, Europe and the US actually now have the greatest economic and trade relationship in the world. On a daily basis, 4.6 billion euros cross the Atlantic in terms of both goods and services trade. So we want to protect that treasure, and therefore we need beneficial agreements to everyone, and that's what we will be trying to do from the EU side. Always being constructive, but also understanding that we need to protect the interests of our industries and our consumers as well.
Let's talk about Spain, of course, a bright spot when it comes to the economy in Europe. The rebound of tourism has very much helped that since the pandemic. Around 13% of GDP comes tourism, but there is a crackdown on mass tourism in Spain. A lot of regions have put some special rules on short-term rentals in particular. So how do you not kill the golden goose to a certain extent? How do you try to put some of these measures in place to crack down on mass tourism while not damage your economy?
Well, actually, Spain's growth story is much more than just tourism. When you look at our exports, for example, we're exporting more on non-tourism services than on tourism, which is usually less well known. And when you look at tourism flows as well, we were just discussing before being on there, what's going on in Spain is now most of the increase in tourist inflows is actually in what we call shoulder months, just before or after the summer break. So there's a bit of deconcentration in how these flows are coming to Spain, also geographically. More tourism related to, of course, business tourism, but also rural tourism, also in the north part of Spain. So that's a positive trend, but still we have to deal with the potential trade-offs that 100 million tourists can produce in the use of services in Spain as well, and in terms of the housing sector.
Yeah, exactly. I was going to come to that because that's one of the issues, the housing crisis in Spain. So what is your government doing to address this issue in particular, beyond some of these measures around tourism?
Well, there are measures around tourism, particularly on short-term rentals. What we want is to avoid that there are illegal postings on websites. So there is a regulation going on there, trying to revamp the supply of housing that went, as I said, in a way towards short-term renters that should be there for medium to long-term renters, so more affordable long-term housing. But also we're rebuilding the housing stock, the public housing stock that was completely depleted after the housing crisis. Just to give you an idea of the extent of the shock, the housing sector, construction sector represented around 13% at the height of the construction bubble, of the housing bubble. Now it's around 6%. So really what we know is that there is still scope for an increase in the size of the construction sector, for an increase in investment and a rebuilding of the housing supply, particularly for the public sector, so that we can again instill this push to supply for affordable housing and therefore also reduce prices and increase the availability for households.
One of the other issues that is identified around the Spanish economy, despite its good health, it's its sluggish productivity. So again, I know it's a really difficult one for governments to address, but how are you trying to address this issue in particular?
Actually, there was a very nice graph yesterday in the FT on productivity per hour, where Spain was actually second to the US. And this is thanks particularly to the last few years, where we've been able to do something that we were not in past growth periods, which is make a growth, job creation compatible with increases in productivity per hour. And this is somehow also part of the success story of the Spanish growth model, that we are building, modernizing our economy throughout also big investments, particularly coming from next generation EU funds. And this is proven to be, again, a good sign for record numbers in terms of job creation that come together with more productivity as well.
And what's interesting when we look at Spain is that economic success is despite a very fragmented political landscape. And some identified it as a potential key issue going forward. And recently there's been some issues with the Sanchez government, some corruption issues with some people close to the party. This weekend, a sexual harassment case. The Prime Minister is announcing some key measures, anti-corruption measures tomorrow in Parliament. This seems to be very complicated. And how many scandals can pile up on Pedro Sanchez before he has to go or before he has to call a snap election?
Well, decisive action has been taken, as you said. More measures will be announced tomorrow by the President. And I think that should not put any shade on the accomplishments that we're doing that we've been having for the past 7 years, where we've been actually making two elements compatible. On the one hand, growing, but on the other hand, basically gaining new social conquest, new social benefits for our citizens, including, of course, increasing minimum wage, including now the next frontier, which is reducing the number of hours that we will be working on a weekly basis. So there are elements which I think have been up until now not able to come all together. We've been making them compatible, growing, but for the sake of reducing inequality in Spain, for the sake of actually increasing real purchasing power of households, for the sake of creating jobs, and all these, I think, is what actually is important when you look at the track record for the past 7 years.
One of the ingredients of the success of Spanish economy recently has also been immigration. You've actually opened your doors at a time when a lot of countries are closing them. You've opened your doors, and that's helping your economy. Some people say Germany did that a few years back, and that actually fed the rise of populism in that country. So how do you make the case for opening your doors to immigration and that it's a boost for your economy?
Well, Spain, as you said, has been actually having an inflow of around 500,000 people on a yearly basis, and this has been, of course, instrumental for us to be able to maintain the labor workforce, and this is, again, a key factor for growth going forward and also for the sustainability of our public finances. 70% of our immigration comes from Latin America. It's an easy integration process. We have to keep on working on that integration and making the best out of these immigration flows with the best matching between their, of course, their skills and the job offers that are now available in Spain, so that, again, we maximize that potential, we maximize that productivity, and we take care also of the social angle, of course.
May I ask you about Next Gen EU? Of course, Spain has been the second biggest beneficiary in some of these funds. Almost half has not been executed in terms of grants, and we just have 1 year before this money has to be used. Will you be able, because there's been some criticism against Spain a few years back that the delivery was being slow on distributing that money. Are you confident that you will use that money before the deadline next year?
Well, actually, yesterday we had good news on that front. We got a new disbursement green line from the Commission, so that 70% of the grants will have been disbursed by now, 55 billion euros. So we are country number one in terms of grants disbursement. We're still pushing ahead to be able to, as you said, make good use of these almost 80 billion in grants that were allocated to Spain, because this is key, this is instrumental for our growth, for the modernization of our country. So there were two main goals from Next Gen EU funds. So first, to get out of COVID without scars, and then at the same time to be able to have this medium to long-term view to modernize our economy, to increase our productivity, to reduce electricity costs with this huge bet for renewables in Spain. All of this is happening at the same time, and this is thanks to the efficient use of Next Gen funds.
May I ask you about climate change? We know that Spain has been facing a lot of big climate events recently, the floods last year around Valencia. You were in Seville just last week, it was something like 45 degrees. How do you prepare an economy to deal with these kind of shocks that are just becoming stronger and just more frequent?
Well, there's on the one hand, of course, the element associated with our energy mix, how we are preparing to have security in terms of our energy supply going forward, to have also lower costs, a competitiveness edge out of our bet for renewables. Just to give you a number, the increase in the renewable share in the electricity mix over the past 5-6 years has implied a drop of 40% in wholesale electricity prices. That's also, of course, a key factor driving the income of foreign direct investment in Spain. We're number 5 in the world in terms of greenfield investments between 2018 and 2024. That's by how much Spain is attracting foreign investors. And at the same time, of course, we have to take care of potential disasters, not only with the prevention, but also with an element associated with insurance policies. And we have a specific public system in Spain that actually deals with the reimbursement of the costs associated with natural disasters for firms, for citizens, and this is actually proven to be essential for us to avoid a bigger impact in terms of deficit, but being able to actually channel by now almost 3.6 billion to the economy, to the real economy in Valencia after the floodings of last November.
A very final question, because you mentioned the energy mix in Spain. The question of the blackout, there seems to be not a lot of transparency about what happened. We still don't really understand what was the cause of this, and what the government is saying is what the network operator is contradicting. Why is there not a clear explanation yet about what happened during the blackout? Because it means maybe it could happen again.
Well, there was actually just a few weeks ago a fully fledged report on what happened with specific causes that, there is no one specific or one cause or one origin, which was a multipolar origin that was identified. And we, I think 2 weeks ago, we did put in place measures, as you said, to avoid that this will happen again, taking advantage also of the big penetration of renewables in Spain to have further control on tension events as well. So on this, everything is being taken care of.
Carlos Cuerpo, Spain's economy minister, thank you so much for your time this morning. And with this, Juliana, I'll send you back over to you in London.
Charlotte, fascinating interview. Thank you so much for bringing us the coverage from Brussels. Coming up on the show, Amazon kicks off its Prime Day event with analysts projecting a record week of spending. Plus, Shein reportedly files for a Hong Kong listing after failing to secure approval from Chinese regulators to list in London. And we'll discuss trading in tech with the CEO of Robinhood, Vlad Tenev. That conversation is coming up at 8:30 London time.
All right, welcome back. President Trump's budget bill is forecast to add trillions to US debt over the next decade, with a potential knock-on effect for the country's global standing. Leslie Picker has more in this special report on America's deficit reckoning.
When Admiral Michael Mullen was asked back in 2010 what he thought the biggest threat to national security was, his answer shocked the nation.
I responded that the most significant threat was our national debt, which was a bit of a surprise. The reporter and others actually would have expected some kind of weapon system or some kind of country or something like that.
The former chairman of the Joint Chiefs of Staff told us that as debt levels rose, his concern was that interest payments would, over time, squeeze the discretionary defense budget. Historian Neil Ferguson published research recently which says that a great power that spends more on debt servicing than on defense risks ceasing to be a great power. This year, the U.S. is expected to spend about $90 billion more on interest payments than on defense, deepening a critical tipping point that America hit in 2024. The recent tax and spending legislation that was just passed is projected to increase defense spending by $2 billion this year and $150 billion over the next decade. The Committee for a Responsible Federal Budget estimates the law will boost interest costs by $700 billion over the next decade. I asked Admiral Mullen whether our adversaries pay attention to our debt levels and see them as a potential vulnerability.
I would think that Putin in Russia, Xi Jinping in China see this as a vulnerability. And you've heard President Xi in China over the last certainly decade plus talk about the United States being in decline.
The irony is that China is one of the largest foreign holders of U.S. treasuries, although it's been steadily reducing its stash. Japan holds more than $1 trillion worth of U.S. debt, the most of any foreign country. They really started accumulating U.S. debt in the late 70s and 80s through trade. While the White House says higher tariffs will generate additional revenue to shrink the budget deficit, there's also a looming question about what the reworking of global trade relationships might mean for international demand for treasuries. Check out our multimedia special report, America's Deficit Reckoning, at cnbc.com/deficit reckoning. For CNBC Business News, I'm Leslie Picker.
Okay, that's right, and that's kind of the mainstream what we're hearing from a lot of economists as well, that it's going to add trillions to the debt. We heard this from the non-partisan Congressional Budget Office, that it's going to add $3.3 trillion to the US debt pile over the next 10 years. But we have to be balanced, we have to be open-minded, and we have to be aware of the fact that the administration, Kevin Hassett, Scott Bessent, Lutnick, and of course the president himself, and a whole host of others, absolutely refute that data. And they say that the growth that they are going to create from the big budget bill and from the tariffs and the revenue there is going to more than offset. So I hear what the economists are saying, and I think Leslie Picker's piece is excellent, but the administration begs to differ.
Well, the reality is when there are red flags, do you just ignore them or do you start to take notice? And we had one recently that the interest payments now exceed defence spending. And after all of the big drum beating that President Trump has done around defence spending, I think that is quite a significant signal now that these effectively wasted payments to cover interest are now higher than the defence spending.
The drum beat about defence spending, Karen, wasn't about American defence spending. It was about European defence spending.
Yes, but it does go to the heart as to whether the Americans can continue to spend in the same vein down the track if those interest bills keep on rising. So that is the red flag, isn't it? The warning signal. In terms of what we've got on a time frame, and there was some analysis in our CNBC report suggesting that the clock is ticking, that there's 20 years to tackle the problem. Otherwise, forget it. No matter what you do on tax and spending, you can just not get ahead of the problem. And 20 years might sound like a long period of time, but you chop that up into various different administrations, and it really isn't very long.
You know, listening to Scott Bessent yesterday, this administration wants to say that they've got a big growth agenda and that's going to take care of the deficit problem. To your point, Steve, he said, Scott Bessent yesterday saying to our colleagues that the U.S. has a spending problem and they're trying to accelerate growth because that solves a lot of the deficit problem. But you have to believe in the growth story and you have to believe that these tariffs are going to drive some jobs back to the States and drive growth to really buy into their whole agenda and connect the pieces here. I think the other thing that stuck out to me from Leslie's report was a line from Ray Dalio, and he's raised concerns about debt for a long time. But he said in the piece that the U.S. is showing classic signs of a late-stage debt cycle, ascribing a 50% chance of trauma in the next 3 years.
Yeah, but with respect to Mr. Dalio, and that's, you know, I'm a huge fan. That's saying there's a 50% chance of it not happening.
Yeah.
You know, so go back to our original point about whether the market's reading this right or not, that we made right at the top of the show. He with respect to the gentleman, he's saying, yeah, 50% is going to be trauma, 50% will be okay. So, you know, what do you do with that? What do you do with that when you're trying to trade?
Well, let's go to the other side, to the deficit side, because what we've seen even in recent years, and you know, over the number of years, we've seen something hiding in plain sight can actually be a problem down the track. We've all known what some of the issues may be, and we all know that spending an extraordinary amount of money when you've got a growing economy is not the right economics. And this is not just when it comes to the United States, it's other countries as well. Why are we spending 6% of GDP when we do not have a crisis and we do not have a war? I mean, that's extraordinary. There is
6% GDP.
6%, the deficit will climb to 6% of GDP this year. Why are we spending that sort of money when there's no war, economic crisis? Typically, though, that type of spending was reserved for moments of reckoning when you really needed to step in, needed to support the economy because it's going deep into a spiral because of some sort of financial crisis, economy issue, or you're combating a war. That is not the case right now.
I think, you know, there's two factions to consider here when it comes to the deficit. How much does the American public care, and how much do foreign creditors, how willing will foreign creditors be to continue helping the U.S. Fund itself? And on the first point around how the American public feels, we're going to have a litmus test pretty soon, because this is the main issue that sets Elon Musk apart from the Trump administration. It's Trump administration. It's how he feels about debt and the deficit. Is that going to be an issue that resonates with voters? My inclination is to say it's not going to be a big issue that resonates with voters, because that's not what President Trump won on. He won on his policies around immigration and America First.
4 parties on the right now, potentially. You've got, you've got the Musk party, you've got the Collins wing of the Republican Party that is very worried about what the social spending is, in Murkowski's end of the Republican Party. You've got the MAGA part, which is the main part, obviously, for the foreseeable future. Then you've got the Rand Paul part, who thinks that we've missed an opportunity to kind of actually cut the deficit, as you were saying. So, the right, as much as and by the way, I'm not saying the Democrats are unified. They're in a terrible state and haven't provided the kind of opposition that people would like to have seen. But the fact of the matter is, there are splinters in the Republican Party, which I wonder, and as you quite rightly say, we're going to get the reckoning tail end of next year. It's going to be fascinating which wing of the Republican Party and whether the Democrats are going to come to the fore. Lots of big questions. In the meantime, we have the European futures to break, which are showing actually very flat moves, despite the fact that we saw some solid old declines in the United States last night. We are called flat at the opening of European equities.